Welcome. This is our review of the closing disclosure statement. Now, here in the state of Utah, there's a significant portion of the national portion of the exam that take questions from this 5-page document. Many states actually have you calculate some of these numbers. Haven't seen a lot of calculation questions in Utah, although there is rumor of one going around where you had to add a couple of columns up, just a little brief little thing, just some very easy math, because they've taken that final figure off. But we can either confirm or deny that rumor, but we're working on it, and we will know soon. But this is a great forum that has a real good practical application in our industry, because it goes through all the basic information and all the detailed exact information that buyers and sellers really need to know. And that's why it's called a closing disclosure, when they go up to the closing. And this is one of the documents that the course they will be signing, and it's one of the documents that you really ought to have a familiarity with. Now, I want to emphasize that again, because our test here in Utah, the national portion of it, has a significant series of questions in regards to the figures on this form. What it really is a crib sheet. It's a sheet that has all the answers to your multiple choice questions pertaining to the particular topics on this form. That's a great thing. Unfortunately, however, it is 5 pages long. And so since it is 5 pages long, you have to be familiar with the form. So I want you to be able to know, because you've read the form a couple, 3 or 4 times, and you've practiced with some of our practice materials, so that you can kind of pretty well locate where these questions are answered on the form, because you're not going to have time, and you will have all the time you need if you're careful about how you're taking the test. But if you're foolish with your time, if you spend too much time working on one math problem, which is just one math problem, okay? I mean, it's either A, B, C, or D. Pick one and go on to the next question, even if you missed it. Okay, it's just one question. Don't spend 10 minutes working on one question. Most questions on your real estate exam can be answered within a few seconds, maybe 5, 6, 8 seconds is all you're really going to need if you are familiar with the vocabulary. This is imperative that you know the vocabulary, because most of the questions on the exam are vocabulary based, or at least they have a significant leaning one way or another, and you won't know which way to go with that question unless you know what the terms mean. And of course, most of the terms that we have in real estate are not your ordinary terms that we use in the English language. And for those of you where English is your second language, well, it could be an advantage, but most likely it'll be a disadvantage, because you're just struggling with the complexity of the English language to begin with. But you can still do this. You can do this. You can pass this exam, and you can pass it the first time, but it's going to take some effort. And for those of you that are not native speakers, or for those of you that are native speakers and just are flat lazy and don't learn the inventory, all of the inventory of the vocabulary, you've got to know that vocabulary, and there's a long list of them. It's about 400 terms, and we've got some great material to help you with that. I've even got a Quizlet program that I'd be happy to get to you. You can email me at rick@rickroller.com, and I'll email it back with the password, so you can use that no charge. Okay, so let's first start by looking at the actual 5-page document, which is called the closing disclosure. So let's pull it up on screen, and we'll kind of walk you through it. Okay, like I said, it's 5 pages, and if you look to the bottom right, it says this is page 1 of 5. It's in the very bottom down there. Now, going up to the top on this form, it tells you right up here in the top left-hand side, the closing information. So if you had a question that said, what is the closing date? Where would you look on the form to find the closing information? Top left-hand corner. Run the cursor up there for them. Dan, there you go. Great, thank you. By the way, Dan is our technical advisor again today, and running all the the keyboards and everything else necessary to make this work. And he put this presentation together. Great job.
Always happy to be. Thanks, Rick.
It tells you who the title company is right there in the same spot. Okay. Now, as you walk across this first little section right up at the top up here, okay, it has information on who the borrower is, who the seller is, and who the lender is. Okay. And on the far right, your far right, how long is the loan term? That says right there in the form, loan term, 30 years. And it's a purchase money mortgage. The purpose of this loan is to purchase the property. Is it a VA? Is it a FHA or conventional? Well, it says loan type and it's picked. So then as you go down into the next section there, and notice these sections now have a black kind of tabs on them that tell you what that section is. The first section is loan terms. And so you see the amount of the loan, you see the interest rate. This interest rate is expressed in 3 decimal spots. Usually you don't see one that goes out that far. I mean, in real life you do, but on the test, it usually only goes out to 3 spots, 3 places or 2 places on the other side of the decimal. And then what is their PI payment? And is there a prepayment penalty? Yes, there is. What is it? Well, it can be as high as $3,240, Is there a balloon payment? No. And then getting into the next little tab, projected payments. What is a PI payment, principal and interest? What is mortgage insurance? Is there mortgage insurance? Okay, see that little box that says years 1 through 7? Yeah, there's going to be mortgage insurance of $82.35 a month. And that's because they didn't have a 20% down payment. If they had a 20% down payment, there wouldn't have been a mortgage insurance at all. And then going to that next box on years 8 through 30, that you see the mortgage insurance actually drops off. Then there's estimated escrows, and those escrows are going to change over the years. Escrows are things like, that they will change over time. It even says that on the form, okay? So that's giving you your estimated total payment in years 1 through 7 because of the mortgage insurance. It'll be about a little over $1,050.26. And after that mortgage insurance drops off, it'll be $967.91. Okay. And then there's estimated taxes, insurance, and assessments, and property taxes, homeowners association dues, no. Okay, other. And then the closing costs at the very bottom here. So closing costs is important. And what are your closing costs? $9,712.10. But this last figure here, cash to close, $14,147.26. Great information. Now, obviously, folks, you don't need to memorize that it's going to be 3.875%. That'll change depending on which example of the closing disclosure form that you will be given. And so you don't know. So they have several different ones. So that really won't, and you don't need to memorize things. Remember what this is there'll be a multiple choice question. And we're going to go through about a dozen of these in just a few moments to show you how it works. But you're looking for which one of those A, B, C, or D, which one of those 4 is the right answer. And you're going to find the answer on this form. Okay, or use it for some variation of finding the answer on this form. Okay, or it's just a general principle of truth in lending, which is another definitional thing. All right, so that's page 1. Let's go to page 2 quickly. And we're going to pick up the pace here a little bit. Now here you see our black tabs. We've got the loan cost. And these are all the costs to put the loan together. We got an underwriting fee up there, application fee, and a loan origination fee. And then you go down, there's more costs, other costs on the next tab down there, and you go down through there. And this will show you your prepaids, things that you have to pay up front, like escrows for taxes and insurance and whatnot. And then I like how if you'll see under these tabs, look at the tab that says under other cost. You know, it has the little subsections labeled with an E, an F, a G, an H. You know, so you can kind of find these a little bit more if it happens to reference that area. Okay, there's some other costs, and it gets down there, and you've got some totals and whatnot. Now, if you look at this form a little more closely as you get into the meat of it, as you go to the right, there's a whole column there where the borrower pays, and then there's a column where the seller pays. Okay, and then paid by others. You know, like maybe you or the title company, or maybe it's a prepaid item. You know, like you know, paid for the appraisal in advance or something like that. So that's kind of how this page is laid out. Let's go to page 3, please. And we'll go through these pages again as we're answering our questions. Okay, this is page 3 of 5, and we've got calculating cash to close, how they came up with that. And then we've got kind of a summary of the transaction, and we have 2 sections here. We have the borrower side, and then we have the seller side. Okay, so kind of cool. It tells you, obviously, if something's on the seller side, it means who's paying that. Well, the seller is. If it's on the borrower side, then the borrower's paying it. Then you've got some calculations down in the very bottom line of this form, cash to close from, you know, and this is on the borrower's side. So the borrower's got to bring in $14,147 and change. And cash from the seller, or to the seller, how much are they going to walk away with? Well, there's a figure. So, you know, and of course, these, don't focus on these figures, focus on where to find them. Okay, because that's going to change from closing to closing. Let's go to page 4. This is so cool. You know, this page is more of a page that has some boilerplate things. And like, for example, if you look under loan disclosures here, is this loan assumable? You know, the right up at the top says assumption. No. Okay, and then is there a demand feature? Meaning, can the bank say, okay, we don't like being banks anymore, and we don't like you as a lender either. So, you know, you got to pay your loan off now. You know, okay, there is no demand feature. You know, that would, I don't know how you'd sleep at night. Okay, late payments, how you handle those. Does it have negative amortization? Look what's checked. Does it? No. What about partial payments? Now, what if you get in a position where, you know, maybe both of you lost your employment, or there was sickness involved, and, you know, a lot of the problems that you run into in life? Would there be an opportunity to go to the bank and kind of negotiate a lower payment for a bit? Possibly. Okay, but this kind of gives you the rule there. The bank could accept payments that are less than the full amount due, and then apply them to the loan, you know, if they want to. You know, they can work with you on that. Now, as you go over again to the more of the right, you've got some you know, escrows, and you've got, you know, what the estimates are there for the taxes and other non-reoccurring costs, and other reoccurring costs. And then you go down and then there's a disclosure at the very end down there. It says, in the future, you know, your property costs may change. Of course they will. We know taxes are going to go up or maybe go down. Who knows? Well, you know, but there are a lot of things that could change, and this is just kind of giving you a warning on that. And then let's go to our final page, which is page 5. Cool. Now on page 5, you know, we've got the name of the bank, the lender, the mortgage broker, the real estate broker. So where, you know, this is where the real estate broker kind of chimes in here, so you can see who they are and whatnot, and who the title company is and whatnot. And then up above, it's got some more loan calculations. You know, here's where you could find it. You know, that at the bottom figure there, is that the total interest percentage that you're going to pay is almost 70% of your payments and whatnot are going to be just interest. Yeah, but we all knew that anyway. So anyway, but that's kind of how, and a little on the appraisal, all kinds of interesting stuff, which you're going to need for the test. All right, so let's jump into some questions. Let's go. Okay, now here's a great question. What is the interest rate of the mortgage loan that the buyer is assuming? Okay, is it 3.88, 3.5, 4.17, or 4.50? Okay. Now, this is the question. Now understand that you're going to have the closing disclosure on the computer in front of you. And so take some time when you first sit down before you start the clock on taking the test and work through the procedures you need to move pages forward, backwards, and just the simple manipulations of using a computer. Many of you use computers every day, all day, and many hours every day, and you're really good at it. Others are not. And so you can get by without being a computer savant because they've tried to make it very, very easy. But if you hurry to start your test, your clock does not start until you hit the button, I'm starting the test. You could play with their software program for 15, 20 minutes if you wanted to, learning how it operates and works. So you're not stressed about flipping from one page to another, marking a question for review, or any of those types of things that the software allows you to do. All right, so we've got to go to our form now. And so in order to see or to answer this question, we're going to look at the very first page. Now, if you look at the first page, the first black tab says loan terms. See that? So this is how you're going to find them, okay? And so what is our question? The question is, what is the interest rate of the mortgage loan they're assuming? And there it is, 3.87 and a half, but that's expressed as 3 decimal points over. And none of our questions go to 3 points. They just go, they round it up. So they just go, so what is closest? Well, the 4s are out of the picture. The 3.5 is out of the picture. It's 3.88 because you rounded up that last digit of 5 to make it 2 8s at the end. Okay, you can do this. They gave you an answer sheet. It's just, you're just going to have to, please spend some time with this form and do some practicing so that you can easily find this. If you knew that on the first page, flip back again real quickly, Dan, that this is where you find the loan terms. Oh yeah, it's on that first page. This would only be like a 30-second question, because there it is. Okay. Oh, there it is, 3.88. Well, did not. Oh yeah, that's it. 3.88. You rounded up the 7.5. Okay, great. Let's go to question 2. Question 2 is, what is the prepayment penalty on the mortgage loan? Up to $762.78 on a high end. There is no prepayment penalty. There is no one. No, well, I don't know. I think there is. Up to $9,712.10 or up to $3,200. Okay, and change, $3,240. Okay. Well, there is a prepayment penalty. If you reviewed the 5 pages just real quickly, so you kind of get a feel for the loan, you knew that one is not right. So going back up here on our page, under the loan terms, there's a column marked prepayment penalty. So does it have a prepayment penalty? And in big bold letters, it says yes, there is. But what you need to answer the question is as high as $3,240 during the first 2 years. And then it kind of drops off. But so look at our question again, up to $3,240, which is answer D. You could do this, right? They gave you an answer sheet. You just have to interpret it and find out where it is. So, okay, 2 up, 2 down, and we're both on the first page. So the loan terms, first page, is there a prepayment penalty? And what was the interest rate? So cool. You can do this. Let's do number 3. How many years will the borrower have to pay mortgage insurance? Okay. Well, gosh, I guess we're going back to the loan terms again, aren't we? Let's take a quick peek. Is that right or wrong? Let's go to page 1. Okay, what they want to know? They want to know how many years will the borrower have to pay mortgage insurance? And looking a little bit further down from loan terms, it's projected payments. This question was about payments. How many years will the borrower have to pay mortgage insurance? Oh, look, projected payments. Oh, look, there's something under projected payments called what? Mortgage insurance. And it shows here for the first 7 years, they got to pay $82.35. And then if you look over to the next column of numbers, in years 8 through 30, they drop the mortgage insurance fee. Now, mortgage insurance, as you know, okay, is not insurance that if you die, the loan's paid off. It's insurance that if you default, the bank's not going to lose any money because there's an insurance company behind it that takes this $82.35 and they insure to the bank that the bank won't lose any money on their loan. Now, so that's kind of interesting. So the bank, if they had to foreclose, are going to take your house, they're going to sell it at auction, or after the auction, if they're the highest bidder, no one else bids. And when the dust settles on everything, if they might even make money, probably not. They might lose a little money, and if they do, because usually they're not in very good shape, and if they do, then well, this $82.35 they've been accumulating over the last 7 years as a insurance premium will help defray that loss. And so this does not benefit the borrower at all. It benefits who? The bank. That's okay. Well, it benefits the borrower because you wouldn't have got the loan. They wouldn't have given it to you if you didn't have the insurance. And yeah, I guess it also helps people get into houses that can't scrape up the 20% down payment. But it's always better to have the 20% down payment, right? You bet it is. And you're going to be making a lot of money in real estate. So just save your pennies and nickels and $1,000 commissions and $20,000 and $15,000 commissions so you can make a good down payment. Okay. All right. So let's go to our next question. And then the next question is, okay, going back, that was 7 years. All right. So number 4 is now, what is the term of the mortgage loan? Hey, we're going back to page 1 again. Whole lot of answers on page 1. And we now they're not going to conveniently always ask you about page 1. I mean, we just said this so you'll get to know what's on this page. And hopefully by the time this little class is over, even if you have to watch it a couple of times, you'll be in good shape on where a lot of this stuff is. So what are we looking for now? We're looking for what is the term of the loan. And let's look at the very top again, even above the little black tabs, way over on the right-hand side. And it says loan information. How long is it, guys? Ladies and gentlemen, how long is it? Drum roll. It is what? 30 years. You got it. 30 years right there. Now, once you've found the answer, you go back, you'll see it C, you mark C, and you forget about it. And you go to the next question. Just forget about it. Go to the next question. Do not take little pieces of these questions and hang on to them and put them in your psyche, and like it's something special, or maybe I want to rethink this. Just think it through, find a question, mark the answer, forget about it so that you're into the next question with your whole full attention. If there's any question about it at all, mark it for review. So the computer will bring it back to you later. But you need your full attention on the questions as they come up, which brings us to number 5. Question number 5 says, What section discloses the commissions paid to the agents in the transactions? Okay, is it H, F, C, or B? Remember those letters I pointed out to you? Well, where do you think C and B are in? And well, they're got to be on the first page. Okay. All right, whatever. So what we want to answer on this one, what section discloses the commissions? Well, actually, it's on page 2. Okay. Because here we get into loan cost and we get into other cost. And looking this over, we're looking for something that will identify right down here, commissions paid to realtors. I don't know. Hey, Dan, most people, once they've had a little bit of familiarity with these forms, know exactly where to find out how much money they're making. And there's big numbers. Now, this is a cheap house. I don't even think you could buy a lot in our area for $180,000 anymore. But anyway, but commissions are still reasonable. $5,700 to one side and $5,700 to the other side. Commissions are normally split between the listing agency and the selling agency, and that's what we have here. And they even name them. You got Omega and Alpha. Two fine companies in town. And now that $5,700 won't be all yours, but most of it will, because your broker's going to want a little piece of that too. Okay, cool. So what's our answer? H, the other area. And you found that with that little letter that was out to the side. Okay, cool. I think you guys are getting the hang of it. Let's go to number 6, please. If the borrower wanted to know how much actual loan origination fee she's being charged, is what section would she look in? Okay, she wants to know. I mean, how much am I being paid for these loan origination fees? So we're going to go back to the form. What page do you think we're going to, guys? Of course, you don't know because you haven't read it that closely. But let's go over there. Back on page 2. And we're going to highlight the area that you're going to find this in, which is right up at the top. And you'll see right there, it says origination charges. So, and there's some figures there, but they don't care about figures for our question. They just care about what section. And you see the A, and you see origination charges. And you go back to your question. Well, I sure wish they would let you do split screen, or and some of you might be able to, I don't know, but you're gonna have to flip back and forth. Or 2 screens would be great, but oh well. And you see there, the answer is A, origination charges. Well, the answer is C, which is found in A, origination charges. You can do this. Okay, it's just on the answer sheet. Okay, cool. Let's keep going. Let's do number 7. According to the closing disclosure example, who pays the transfer tax? Now, this is a national produced test. We don't have transfer taxes in Utah. We do have some pretty hefty, in some areas, condo transfer fees and whatnot, and you have to join the association. And so sometimes they charge you another application fee and whatnot. But a transfer tax is really more of a government tax. It's kind of like a sales tax on real estate sales. But we don't have it in Utah, but it's on this test because they do have it in most other states. So we got to go to our form to see who is going to pay the transfer tax. And we're still working kind of through page number 2, and it says other cost. You see that? So looking at this on page 2, and who's going to pay it? Well, if you're looking at the same form I'm looking at, it says the seller's going to pay it. Well, how do we know? Well, it's in the seller's column. Move to the top, seller's column, seller paid. buyer paid. Okay, that's how you interpret this particular answer. And that is answer D on our form. Cool. You know, if you just work on this, you're going to say to yourself as you're in there doing the test, man, I wish there were more questions on this closing disclosure form, because the answers are right there in front of you. Okay, so let's go to number 8, please. All right, we're talking about a credit report. Will the credit report for the borrower be paid at closing or before the closing? Well, if you know about real estate, you know that it's typically paid before the closing. But let's go check it. Let's go check it. And now we're still on page 2. And right there, it's got some credit report fee. And what did it say? Before closing or after closing? Well, it's in the before closing column, and that's a pretty cheap credit report. But anyway, so it's about $30, and it was paid before the closing. Remember, this is information a lender needed in order to determine whether they wanted to give you the loan or not. So, obviously they're not going to go to the closing, then pull the credit. Although sometimes, please tell your borrowers not to run down to RC Willey and charge up $25,000 worth of refrigerators and appliances and sofas and whatever else they wanted to buy for their new home before they close, because lenders do many times pull an additional credit report right before the closing, like a day or so before. And if they see that you've charged up a whole bunch of stuff, well, that's going to change all your ratios on whether you can afford this house or not. Most people don't buy right here in comfort level. They buy right here, right at the top, and it's not, it's not that they're spendthrifts. It's just that they need a nice house, and you can't get the nice house for the lower price. Usually you're going to have to pay a higher price to get that nicer house. And so by the time they run down to RC Willey and buy $25,000 worth of additional debt for stuff that they need, you knock them out of qualifying. Now, you can do whatever you want to after you close, but before you close, please, preach to your borrowers. Do not buy anything. Do not charge up a lot of credit cards. If your daughter comes to you and say, well, Dad, my transmission went out and I can't pay for it, can I borrow some of your savings, or will you put it on one of your credit cards? It's going to kill your closing. You can't do it. They say, well, I'm sorry, honey, you're going to have to swim on your own here on that, because we haven't closed on our house yet. That we're closing next week. So, or take the bus. We'll figure that out after we close. Okay. So, people think that, I don't know, what's a realtor do anyway? Heck, we found the house. I don't care who found the house. I care who got the deal closed, who negotiated the thing and made it happen. Realtors play a vital role in making sure these transactions are put together, that everyone understood what they were doing, that they were educated, and that they didn't do something stupid which prevented them from closing on the house. But every realtor you talk to will tell you that they've lost deals because, they didn't educate their borrowers the way they should have. Well, the way you educate your borrowers quite easily is to make little videos and send it to them. Now don't you dare go out and do this, and don't do that. And yes, keep doing this. Okay. All right, let's go to number 9, please. What is the tolerance for cost to increase for title insurance where the lender allows the borrower to pick up title provider from a list of companies that they provide? Is it zero tolerance, unlimited tolerance? Okay, one way or the other. The lender pays these fees, or 10% tolerance. Well, the answer is D, 10% tolerance, and you're not going to find it on the form. But it is part of truth in lending. Up here in calculating the cash to close, will give you the actual figures. But when they're saying about tolerance, what they mean is these are estimates and there's the actual, okay? So you've got the final, which they call it the final. So if the final is higher than 10%, that lender could get in big trouble. So lenders are getting really accurate in calculating these figures because there's fines and other things that they may have to pay, or they might, if they're doing this a lot and they've got someone angry with them on a regulator side, they might even lose their license or be subject to license discipline, which you don't want that either. Number 10, please. But it's 10%. Okay. What is the total amount that the borrower owes at closing according to the closing disclosure document? In other words, how much are they going to have to come in? Now, this is not just their closing cost, but it's the total amount that they owe at closing. Okay, so it's not what are their total closing costs. It's the total amount that they have to bring in to buy the house, with including their down payment. Okay, so you got some big numbers here. I mean, D's not very big. We could probably throw that one out. But and A's not very big. We can probably throw that one out. So it's either going to be 190,000 about or 175,000 about. Okay, so let's go back to our form and find it out. And we're going to page 3. Okay, and looking this form over, where do we find our figure we're looking for? Well, it's on the bottom line. That makes sense. If you're looking for like total amounts of something, I would look towards the bottom line. And there it is, right there. And what is it? Well, it's 189,762.30. Okay. And they don't want you bringing in a briefcase with, about $190,000 in it. No, they're going to want that money wired into the title company, or if the lender's closing it directly into them. But usually it's the title company that's going to be closing it. Okay. Once again, you could do this. It's right on the form. Just have to kind of know where to go, and as we work our way through the form, it makes sense that the disclosure figure that has all of the final calculations in it would be more towards the final end of the form. Let's go to number 11, please. What would happen if the closing costs change from too much from the loan estimate to the closing? Okay, look at 11. Now remember, we got a 10% tolerance here. So what do you think? The closing must be moved to a later date. That's just going to make things worse. The borrower must ask for additional concessions from the seller. The loan amount must be changed to compensate for the difference, or the lender must refund all funds that were charged above the allowed limits. Which one do you think the government's going to make the lenders do? Well, it's D. The government must refund all funds that were charged above the allowed limits. Okay. But we're going to look for this, and this is going to be on page 3, and let's do a little highlighting here. There it is, right up there, calculating cash to close. And that's where we came up with those figures. Got to be close. So, now you can see why the lenders are so accurate, because their wallet's on the line, so they're going to be very, very careful. Look at number 12, please. Question 12. Question 12 says, on which lines of the closing disclosure would you most likely find unpaid taxes by the seller that are being credited to the buyer? Our tax laws in Utah are a little bit weird compared to other states in the union, and we let people slide for a while on their taxes if they need to, and then they can kind of get caught up later. Most states, they have a tax auction every year And that's for the people that didn't pay that year. But Utah, you can slide for 4 years and they'll sell it in the 5th year. Well, okay, that doesn't mean there won't be a day of reckoning for this seller who's been hasn't been paying his taxes. Now, this particular borrower, as we can see, is getting a loan on the house, and their PITI payment does have the TI. It has impounds for taxes and insurance payments. And so the lender doesn't trust the borrowers to go out and make those tax payments. What they're going to do is they're going to have a PITI payment, and they're going to collect money every month that the lender's going to hold. And then when the taxes are due, the lender's going to pay the taxes. And when the insurance is due, fire insurance, hazard insurance on the house, they're going to pay that too, because they want it insured. You know, I don't know what's going to happen in Turkey. Man, it's gotten really horrible over there, but a lot of buildings were destroyed, you know. But if the lenders had insurance, you know, hopefully they'll, you know, they won't go under. And hopefully the homeowners had insurance too for their portion of it. But a lot of lives have been lost over there, 30,000 or more, and still counting, I think. Sad. Okay, on which lines of if I can, okay, all right. So we have different sections, L, M, K, and N. Now, if you couldn't remember which one of these handled the taxes, you know that it's L, M, K, and N. Or you could jot that down in your scratch paper and then go to the form and look for sections L, A, K, and M. Remember, those sections are lettered. You know, see the black tabs right under the black tab. There's K, due from the borrower at closing. Okay. And there's L, and there's M, and there's N. Okay. So which one of these do you think covers that? Well, right there, you know. And it shows that there's going to be some taxes due. And typically there's always taxes because we prorate the taxes, because the taxes are due at the end of the year. And so the period of time in which the seller is on the home, we're going to take that money away from the seller and give it to the borrower. And then the lender is going to take it away from the borrower and put it into their escrow account so that they have the money to pay the taxes. So let's go back to our question again. And we have found that it was section L, line 12, if you really want to be exact about it. Now is question 12. Cool. Have we had to do any calculations? No. There might be that one I mentioned in the very beginning, but that one is just it's the 2 lines above it, and they and they whited out the line below. You just have to calculate those 2 lines together, just add them or subtract. It's add, actually, and then it'll give you the number you need if that was on the test. But there's really no math, so don't freak out over this form just because it has a lot of math on it, a lot of figures on it. It's just reading the form and matching it up with the answers, as we did here. Answer A, section L, line 12. Okay, let's go to number 13. We're closing in here on our class for tonight. Okay, 13 says, how does the lender in the closing disclosure example handle partial payments? Okay, and so we're going to go to the section that the lender may hold them in a separate, this is one of our potentials. The lender may hold them in a separate account until the rest of the payment's made. Or B, the lender may accept payments that are less than the full amount due and apply them to the loan. The lender does not accept late payments, or it wasn't made clear. Well, it has been made clear. And let's go to our closing disclosure form. And this one we're looking at, finally we move to page 5. And if you look on this form, it's even in kind of bold print. It says partial payments. And there's a box, it's checked. And it says may accept payments that are less than the full amount due. So going back to our question, which one is the right? B, the lender may accept payments that are less than the full amount due and apply them to the loan. Now, did it say must or did it say may? It said may, which means that they may not. You may have been it's real important to pay your loan on time, but a lot of people say, well, it's not late till the 10th, or it's not late till the 15th, or it's not late till the 20th or something. Or 5 days, maybe 5, 10, 15 days. But what will happen if you pay it on and stretch that out as far as it'll go? Let's say it's not declared late until it's 15 days past the due date. Then you won't necessarily be a late payer, but you'll be a slow payer. And they'll take that into consideration in your next loan. Because when do you think they want the money? I mean, if it's due on the 1st, they want it when? The day before the 1st. So pay your payments on time. In fact, pay them a day ahead if you can, but pay them on time. Now you got to make this jive with your payroll checks and that kind of thing. But get in the habit of paying it on time. Do not be a slow pay, because when you go to get your next loan, remember, you're not borrowing here, you're borrowing up here somewhere, at the very, stretching to get just as much house as you can get, maybe. But for most people do that. But what happens then is, if you're a slow pay, you may not get it. And my FICOs were okay. They were a little weak, but they were okay, but they were weak. And, you had some other little things we were looking at, and the ratios were really, really high, and you're a slow pay, so, we're not going to give you the loan. So don't do that. Okay, let's go to 14, please. Okay, our question on 14 is, what is the total interest percentage on the closing disclosure example? Now, when we're talking about this particular total interest percentage, what percentage of the payments overall was interest? Now, we know that in the beginning of an amortizing loan, fully amortized loan, or even a negative amortized loan, what happens is most of your payment is interest in the ensuing front part of it, the early years. But in the rest of it, after that, eventually the payment has stayed the same, with the exception of the escrow fees, which could go up because of higher taxes and whatnot. More and more of the money goes to principal reduction, and less goes to interest, which is some advantage there if you want to assume a loan. Now, I sat down with some new agents just a few days ago, and they were really concerned because, the interest rates are 6% and higher a little bit. And gosh, how can you make a living in real estate? Well, hey, I made grundles of money at 12% in real estate. My first home loan was 10%. So, guys, if you need a house, you need a house, and you'd rather not live in your car or your Winnebago. And so, people are going to buy a house. They may not buy as much house, because interest rate's a little higher, and so your payment's going to be higher. But they want to buy a house. Okay. And so what I'm getting at here is, there is a secret, and you could make hundreds of thousands of dollars with this secret. And the secret is, learn how to do assumptions. Because the government has leaned on lenders and has told them that we would like you to do assumptions if you can. In most of the assumptions, the rate stays the same. So there are hundreds of thousands of 3%, 3.25%, 4% loans out there that are fully assumable with credit qualification. But heck, it's easier to qualify at 4 than it is at 6. Okay. That buyers can assume, And then we'll work out the difference one way or another. Maybe we'll do a blend loan. Maybe we'll get them a second mortgage. Maybe a owner will carry, or maybe they have enough down payment. Many of the buyers that are flocking back to Utah these days are rolling into town with hundreds of thousands of dollars in their bank accounts because they sold their homes in California. And so they're looking for an assumption. Okay. So, all right. So, what's this have to do with the overall closing percentage? Well, as a loan is paid down, you're going to get in the further end of that. But if the interest rate was smaller, there'll be less of this overall percentage. So there's two reasons to go for an assumption. One is that over time, the amortization schedule shows that less of your fixed monthly payment goes to interest and more of it goes to principal. It's a big advantage, especially after 4 or 5 or 10 years. So great to get an assumption. And then, of course, you may have a lower interest rate to start with. But the point is, this question talked about what's the overall percentage. So let's go to our form again. And remember which page this was on? Probably don't, but you could flip and you could find out it's on page 5 again. Okay. And there you go. Right there in the loan calculation, the last column, Dan has highlighted it for us. And it just pops right out at you because it's answer B. It's answer B. Okay. All right, going back to our questions one more time. And it is, what is the total finance charge for the loan and the closing disclosure document? Okay. 285, 162, 14,000, and throw out the 14,000. We're not buying a cheap used car. D, 118, 830, 27. Let's go to our page 5 again. And here in the loan calculations, that the figure just jumps right out at you. There it is, 118, 830, 27. There it is. Okay. Questions? Okay, your takeaways. Number one, you need to read this closing disclosure 5-page document. Not so you can memorize all the numbers, but so that you'll get some of the general principles in it. You need to remember that Truth in Lending has a 10% factor that they're comfortable with. And if you go over that 10% factor, you could be subject to fines, or you could be subject to paying it out of your own pocket. And lenders don't want to do that. Know where to find things on the form. You're not going to have to calculate something for the form, but know where to find them on the form. Know what you're hunting for, because some of the questions identified, is it found here, 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 or there? So know how to use that code, to find section G, H, I, whatever it might be. Okay. And don't spend a lot of time on other questions on the test before you get to this document so that you feel rushed. I've had some people say, well, gosh, when I got to that point, I didn't have enough time left to answer all the questions. Well, that's going to be tough. What are we looking at on this form? It's an answer sheet for every one of those questions. My goodness, shouldn't you be spending as much time as necessary to get this form done? Because these are 10 or 15 questions that it's on that answer sheet. But messing up and spending too much time on other questions before you even got there, because it's normally towards the end of the test, is a big mistake. So I know you can do this. We have students that pass the test every single month, and they come back and say, well, some of them say, oh man, that was horrible. Most of them come back and say, that wasn't so bad. I thought I was well prepared. We want you feeling that way. We want you feeling well prepared, and we want you to pass the first time, and we want you to go out and bless lives and make money. Now, one thought to live by as you get into the business, okay, and this is something to think about. And that is, okay, this is something to live by, okay? There must be input. There must be output before there can be income. There must be output before there can be income, okay? You're going to have to work in this business. People aren't going to fall in your lap and want to do business with you. You'll get a little of that, but not enough to make the kind of income you want to make in this industry. But you're going to have to do some output. You're going to have to contact people. You're going to have to take the advice that your mother told you all your life, which was, honey, don't talk to strangers, and throw it out the window because your broker keeps telling you, go talk to strangers. Go talk to people you don't know and find out if they want to buy a house or not. And if they do, get them signed up on a buyer sheet. And if they have one to sell, better yet, get them signed up with the listing. Thanks so much for being with us tonight. It's been fun. Thank you, Dan. Appreciate all your hard work on putting this all together. Dan is really committed, and so are all of us here at the school, to make sure that you have a great exam experience. If there's any questions that you have, please call the school, or you can call me directly, 801-556-8000. Happy to help. Happy to spend time with you on the phone. Do not text me and say, is it okay to call? Just call. Okay. We'll spend a profitable few minutes on the phone for everybody, and you'll have a good exam experience. Okay. Thanks for being here. Thanks, Dan.